The markets knew. 3 days before the official announcement, 4 days before the media coverage, 5 days before the public understood what was happening. The markets moved first, massive coordinated systematic movements that made no sense until the headlines finally caught up with reality. Someone knew what was coming. Someone was trading on information that didn't officially exist. Ladies and gentlemen, Asian guy here. What I'm about to show you isn't market prediction, it isn't technical analysis, it isn't algorithmic trading. This is proof of intelligence operations executed through financial markets. This is evidence of information warfare conducted through trading positions. This is documentation of how the most significant financial events of our time were telegraphed days in advance by entities that knew exactly what was coming. The pattern is undeniable once you see it. Every major financial crisis we've documented in this series followed the same sequence. Markets moved first, positions were established, wealth was transferred. Then, the official announcement was made to explain market movements that had already occurred. The news doesn't drive the markets drive the news. Start with the banking rule changes that prioritized institutional survival over customer protection. On Monday, banking stocks experienced unprecedented volatility patterns that made no logical sense based on available information. Tuesday brought massive derivative positioning that suggested knowledge of regulatory changes that wouldn't be announced until Friday. Wednesday showed institutional bond trading that could only be explained by advanced knowledge of settlement hierarchy modifications. The pattern was surgical. Specific banks saw their stocks shorted precisely 72 hours before regulatory announcements that would devastate their business models. Other banks experienced massive institutional buying exactly 96 hours before rule changes that would benefit their competitive positions. The timing wasn't coincidental. The positioning was too precise. Someone knew what was coming and traded accordingly. The $6 trillion institutional exodus followed identical patterns. Alternative asset managers saw unprecedented capital inflows beginning exactly 1 week before the classified Federal Reserve briefings that triggered institutional panic. Physical commodity funds experienced massive subscription requests 6 days before the intelligence assessments that showed systemic collapse probabilities. Private equity focused on real assets received institutional commitments 5 days before the official documents that terrified pension funds into evacuation. The Swiss National Bank's termination of international swap agreements showed the most obvious advanced trading patterns. Swiss franc futures experienced unusual accumulation patterns beginning 10 days before the official announcement. European bank stocks were systematically shorted starting 8 days before the Swiss decision. Currency hedge funds established massive positions 7 days before swap line terminations that would validate their strategies. But the Chinese Financial Independence Declaration revealed the most sophisticated advanced positioning of all. Yuan-denominated assets experienced institutional accumulation beginning 2 weeks before Beijing's official announcement. Western bank stocks exposed to Asian markets were systematically liquidated starting 12 days before Chinese independence became official. Commodity futures shifted to alternative exchanges 11 days before traditional exchanges lost Chinese participation. The advanced positioning wasn't random. It wasn't based on public information. It wasn't generated by technical analysis or economic forecasting. The trading patterns show detailed knowledge of specific policy decisions, exact timing of official announcements, and precise understanding of how those announcements would affect different asset classes and individual securities. Someone had the actual documents before they were officially released. Someone had access to classified briefings before they were officially conducted. Someone knew the exact wording of policy changes before they were officially drafted. The trading positions were too specific, too accurate, too perfectly timed to be based on speculation or educated guessing. The intelligence sources appear to be multiple and coordinated. Trading patterns suggest different entities had access to different aspects of the same information. Some positions reflected knowledge of American policy decisions. Other positions reflected knowledge of Chinese policy decisions. Still other positions reflected knowledge of European regulatory changes. The coordination suggests intelligence sharing between entities that shouldn't officially communicate. The most disturbing aspect of the advanced positioning involves entities that should not have had access to classified financial intelligence. Hedge funds with no government connections established positions that could only be explained by advanced knowledge of central bank decisions. Private wealth managers with no institutional relationships positioned client assets based on information that wouldn't become public for days. Individual traders with no intelligence affiliations executed strategies that perfectly anticipated official policy announcements. This suggests either massive security breaches across multiple government and institutional agencies, or deliberate intelligence distribution to financial entities for purposes that haven't been officially disclosed. Either explanation represents systematic compromise of financial decision-making processes that are supposed to operate independently of outside influence. The trading data reveals specific patterns that identify probable intelligence sources. Positions established through certain prime brokers consistently preceded official announcements from specific government agencies. Trading conducted through particular clearing systems repeatedly anticipated policy changes from particular central banks. Orders executed through specific exchanges systematically front-ran regulatory announcements from specific oversight bodies. The correlation between trading patterns and subsequent official announcements is statistically impossible without access to non-public information. The probability calculations for accurate advanced positioning across multiple unrelated events, using information from different agencies and institutions through different market mechanisms, exceed mathematical possibility without systematic intelligence access. But the most revealing aspect of the advanced trading patterns involves positions that anticipated not just official announcements, but specific market reactions to those announcements. Trades were established based on knowledge not only of what would be announced, but of how markets would interpret and respond to those announcements. This suggests access to intelligence about market psychology and institutional reaction patterns that goes beyond policy intelligence. The entities conducting advanced positioning appear to have access to intelligence about how other market participants would respond to official announcements. They knew not only what policies would be announced, but which institutions would panic, which would adapt, and which would benefit. They positioned accordingly, profiting not just from policy changes, but from predictable institutional responses to policy changes. This level of intelligence sophistication suggests coordination between financial trading operations and psychological operations designed to manipulate institutional behavior. The advanced traders didn't just know what would happen. They helped design what would happen by positioning to profit from predictable responses that their positioning would help create. The manipulation extends beyond individual trades to systematic market engineering, designed to amplify the impact of official announcements. Advanced positioning created artificial scarcity in specific assets that would be in demand after official announcements. Pre-positioned short sales created artificial abundance in assets that would be abandoned after policy changes. The market conditions that officials announced their policies into had been artificially created by entities that knew those policies were coming. The Federal Reserve announced quantitative tightening policies into markets that had been artificially positioned to amplify the impact of tightening. The Swiss National Bank terminated swap agreements in currency markets that had been pre-positioned to maximize the disruption of termination. China declared financial independence in commodity markets that had been systematically prepared to magnify the impact of Chinese withdrawal. The official announcements weren't just preceded by advanced trading. They were preceded by market engineering designed to ensure maximum impact when the announcements were finally made. The entities with advanced intelligence didn't just profit from policy changes. They helped design the market conditions that would make those policy changes as disruptive as possible. This reveals coordination between policymakers and market manipulators that goes far beyond traditional insider trading. The advanced positioning suggests systematic cooperation between government officials who make policy decisions and financial entities who position to profit from the market disruption those policies create. The relationship is symbiotic and coordinated. The mechanics of this coordination are becoming visible through analysis of communication patterns between government agencies and financial institutions. Encrypted messaging systems that don't appear in official government communication logs have been identified connecting Treasury Department officials with hedge fund operators. Federal Reserve staff members maintain private consulting relationships with trading firms that consistently profit from Fed policy announcements. SEC investigators hold equity positions in funds that benefit from regulatory changes they help design. The coordination extends to international levels through diplomatic and intelligence channels. American policy officials coordinate with Chinese counterparts through third-party financial intermediaries that profit from the market disruption created by coordinated policy changes. European central bank officials share intelligence with American financial institutions that position to profit from European policy announcements. Swiss banking relationships facilitate information sharing between government officials and private wealth managers across multiple jurisdictions. The most sophisticated coordination involves the use of academic and think tank institutions as intelligence distribution mechanisms. Government officials provide classified policy information to university economics departments that conduct research that reaches conclusions supporting predetermined policy changes. Think tank studies that appear to be independent analysis are actually policy justification documents written with advanced knowledge of what policies will be implemented. The research is then distributed to financial institutions as legitimate intelligence supporting trading strategies that profit from the predetermined policies. Legal frameworks have been established to protect this coordination from prosecution or investigation. Government officials who provide advanced policy intelligence to private financial entities are protected by national security classifications that prevent investigation of their communication patterns. Financial entities that profit from advanced government intelligence claim proprietary trading strategies that are protected from disclosure requirements. The coordination operates within legal structures specifically designed to make it invisible to oversight mechanisms. The financial entities involved in advanced positioning maintain official consulting contracts with government agencies that provide legal cover for intelligence sharing relationships. Former government officials transition to financial institutions where they provide strategic advice based on their continuing relationships with current government officials. Current government officials maintain equity positions in financial entities through family trusts and shell companies that profit from their policy decisions. But the most disturbing aspect of the coordination involves the use of crisis creation as a systematic wealth transfer mechanism. Government officials create policy crises that generate market panic, while their financial partners position to profit from that panic. The crises aren't responses to market conditions. The crises are created to generate market conditions that benefit predetermined financial positions. The scale of wealth transfer achieved through this crisis engineering is staggering. Each manufactured crisis event transfers billions of dollars from institutional investors and retail participants who operate with public information to intelligence-connected entities who know what's coming. The 2008 financial crisis transferred an estimated $2.3 trillion to entities that had positioned for systemic collapse before the collapse became publicly visible. The COVID pandemic market disruption transferred $1.8 trillion to entities that had established pandemic benefit positions weeks before lockdown announcements. The current financial crisis sequence we've been documenting represents the largest wealth transfer operation in human history. The banking rule changes, institutional exodus, Swiss withdrawal, and Chinese independence collectively transferred over $8 trillion from traditional financial institutions to alternative systems, controlled by entities with advanced intelligence about the crisis sequence. The wealth didn't disappear during the crisis. It was systematically extracted by operations that helped create the crisis. The intelligence operations have evolved to include sophisticated psychological manipulation, designed to ensure that crisis events generate maximum panic and maximum profit opportunity. Market psychology research, funded by government agencies, provides detailed analysis of how different types of financial participants respond to different types of crisis announcements. This research is used to design crisis events that generate predictable panic responses that can be profited from through advanced positioning. The technology infrastructure used to coordinate these intelligence operations has evolved to include artificial intelligence systems that analyze market behavior patterns, predict institutional responses to different types of crisis events, and optimize timing and coordination of policy announcements to maximize market disruption and profit extraction. Government officials benefit because their policies have maximum market impact, creating pressure for additional policy changes that expand government power and control. Financial entities benefit because they profit from the market disruption while helping to create the conditions that justify expanded government intervention in markets. Both sides profit from systematic destabilization of traditional market mechanisms. The pattern explains why traditional market analysis has become ineffective. Technical analysis assumes markets respond to publicly available information. Fundamental analysis assumes policy changes are independent of market positioning. Both assumptions are false when markets are systematically engineered by entities with advanced policy intelligence. The trading algorithms used by institutional investors are being systematically exploited by entities that know what information will be released before it becomes available to the algorithms. Algorithmic trading systems are designed to respond quickly to new information, but they become manipulation targets when other entities know what that new information will be and position accordingly. High-frequency trading systems that rely on speed advantages are being systematically front-run by entities that have time advantages. Microsecond response capabilities become irrelevant when competitors have days or weeks of advance notice about market-moving events. The technological arms race in trading speed is being made obsolete by intelligence advantages. The implications for individual investors are severe. Retail traders operating with publicly available information are systematically disadvantaged by professional operations with intelligence access. The markets are rigged not just by speed or capital advantages, but by information advantages that no amount of individual research or analysis can overcome. Pension funds and institutional investors that rely on traditional investment management are being systematically harvested by operations that know policy changes before they occur. Retirement accounts and institutional portfolios are being positioned for losses by entities that profit from advanced knowledge of events that will damage traditional investment strategies. The manipulation explains why diversified investment strategies have performed poorly during the recent crisis sequence. Diversification assumes that different asset classes respond independently to random events. But when events are coordinated, and advanced knowledge allows systematic positioning across all asset classes simultaneously, diversification provides no protection. The entities conducting advanced positioning have access to intelligence about policy coordination across multiple governments and institutions. They know not just what individual policies will be announced, but how those policies coordinate to create systematic market disruption across multiple asset classes and geographic regions. Their positioning reflects global intelligence about coordinated policy operations. The intelligence appears to include specific timing information that allows precise entry and exit strategies for maximum profit extraction. Positions are established with perfect knowledge of when policies will be announced, how markets will react, and when those reactions will reverse. The timing precision suggests access to detailed operational planning for policy announcement sequences. The most disturbing aspect of the intelligence operation involves its apparent permanence. The advanced positioning patterns aren't isolated incidents. They represent systematic, ongoing operations that profit from continuous policy manipulation of markets. The intelligence access appears to be structural rather than episodic. This suggests that financial markets are permanently compromised by intelligence operations that systematically extract wealth from participants who operate with publicly available information. The concept of fair markets, efficient price discovery, and equal access to information has been eliminated by systematic intelligence advantages that cannot be overcome through traditional investment strategies. The evidence shows markets don't react to headlines. Markets are engineered by entities that write the headlines. The official announcements that appear to drive market movements are actually written to explain market movements that were strategically created by entities with advanced knowledge of what the announcements would say. The game is rigged at the most fundamental level, not through manipulation of individual stocks or sectors, but through systematic engineering of the information environment that all market participants rely on for decision-making. The entities that know what's coming profit from everyone else who has to wait for official announcements that explain events that already occurred. The markets knew because someone made sure they knew. The question isn't how markets predict the future. The question is who controls the future that markets are reacting to. And based on the trading patterns we've documented, that control is being exercised by entities that profit from chaos while helping to create the policies that generate the chaos they profit from. This triggered everything. Not the official announcements, not the policy changes, not the crisis events themselves. What triggered everything was the systematic advanced positioning by entities that knew exactly what was coming because they helped design what was coming. The markets reacted first because someone made sure they would.